See, we are basically operating, we as Indian Electricity Energy Exchange, we have been operating electricity market since 2008. And we were looking for, and this is a basically delivery based market, and we were looking for starting a similar market for gas. And we started in 2019 working on this. Last year in June, we finally started it as a gas trading platform. Of course, since there was no regulation in India on gas exchanges as such, so we were operating it as a gas trading platform. But during the course in September, PNGRB, who is a gas and oil regulator for India, they issued a regulation uh, for regulating these gas exchanges. So under these regulations, we applied to PNGRB for approval, and we got authorization in December. So in on 22nd, on 2nd December, we got approval, and on 10th December, we started this as an authorized platform or gas exchange. So good thing is that we are now a regulated entity, so it gives a lot of comfort to the participants, stakeholders in the gas sector, that whatever we do, that is under oversight of a regulator, and whatever we launch, that is with the approval of a regulator. So that is hopefully very comforting to our stakeholders, because there is a huge obligations are there when you run a transaction for gas, which are of very large sums. It involves large sums of money, and big stakes are involved. So that gives should be giving comfort to all our stakeholders, that when you are operating or trading through exchange, then you are trading through a regulated entity. Then, of course, we are very new, so we are just starting our market. And in the first month itself, we saw that there's been a very odd trends in the market, which supposedly a kind of record that we saw the prices touching something like $30 and $39 and $40 per MMBTU, and that actually it created some waves in our Indian market also, and we could not do much of transaction because of such high prices, because Indian market is not used to that kind of prices. So we are going to, of course, see that what are the reasons, and of course we would also like to keep reviewing that the model in which we operate our exchange. So we started with 3 physical hubs in India, and we started with the contracts which are like a daily, weekly, monthly, and up to a month. So now we are thinking that should we have a longer contracts also, like a 3-month contract or a 6-month contract. So that that's there in the pipeline. So we hope that we should be able to come out with the longer contracts also. We also will have 2 more physical hubs. We are thinking of having a hub at the Dabhol, and with H Energy commissioning its FSRU. And then we also will be, we are proposing for a hub in our east CBM basin, like in West Bengal, Jharkhand area. And of course, we are also looking for if there is any change required in terms of our market matching. So that also we are working on. So these are a few things which we are working on to improve upon what we are already doing. But meanwhile, when we are actually trading a commodity, which is basically an international commodity, and 50% of India's consumption relies on LNG imports. So this is very crucial for us and everyone in India, that we should understand the global trends, and how the whole dynamics play out, and then how it affects India, to what extent what can be done through market, and more we need in terms of market. Do we need a derivatives market so that people are able to hedge their risks from these sudden changes in price, which is emerging from issues happening in the international market. We understand that there was shortage of gas, there was shortage of logistics, there were constraints in few areas for which the LNG could not be delivered to Asian markets, particularly Japan, and that created issue for India also. So this was the time when we thought that we should get insights from our international experts, and we found that we had two great experts from IEA. We could not get anyone better than them. They are one of the best people in the market. So I would just like to introduce two of our experts, and then later we will request them to take us through their talk. So our senior expert, Mr. Sean Baptiste, he has been there in oil and gas markets for 22 years, currently with IEA for last 3 years, and then he has also worked with NG, Science Pro, Ecole Polytechnic Executive Education, and NG, and he has a master's in energy economics. And then we have Mr. Greg Molnar. He is with IEA currently, and he has worked with Wood Mackenzie and Center for European Policy Studies. So both are deeply involved persons in oil and gas markets, and it will be really great to hear their insights on these markets. So welcome, Mr. John Bob Baptiste and Greg Molnar. Stage is yours.
Thank you very much, the Director Mediarata, for this very kind words of yours and your introduction. Good afternoon to everyone in India and to colleagues throughout the world. This is a great pleasure to be with you today, although only virtually, but hopefully next time we'll be able to join you in a face-to-face meeting. So my name is Jean-Baptiste Dubray, as you rightly said. I'm with the IEA since 2017, and I'm in charge of our short to medium term natural gas market analysis. And this is my pleasure today, this afternoon, with my colleague Greg Molnar, to share with you some of the insights we have from our latest publication, the Gas Market Report, which has just been released a couple of days ago this week. So to begin with, could you move to the next slide, please? So to begin with, I'd like to set a bit the scene for this analysis and what has happened to gas markets over the recent past. We so in a few instances you will see the recent evolution of gas demand. There we are. Thank you very much. So as you can see on the left of the slide, gas demand grew for two following years in 16, 17, above 2%. It was followed in what we call 18 being the golden year of gas, almost 5% global growth in natural gas. Then things started to cool down in 2019. The main engine for gas growth in the past was fuel substitution and power generation, with coal to gas switching, mainly in Europe and in North America, and with also some contribution from Chinese national plans of fuel switching. It started to falter a bit, and of course, global economic growth was a bit slower in 2019. Of course, then came 2020. And last year, we saw a global gas market experience their largest ever recorded drop with about 100 billion cubic meters. Sorry, could you switch back to the previous one? Thank you. So we're still on the left-hand side, the blue bars. You see that last year, our estimate is minus 2.5% decline. It's the largest ever recorded drop ever since global gas markets exist. About 100 billion cubic meters, roughly the consumption of Japan in demand lost last year. So this is important, of course, for the this is a first for gas markets, but it has to be taken into comparison with what happened to other fuels. And then we're switching to the other side of the slide. You can see that compared with other fossil fuels, gas has remained particularly resilient. If we compare it with oil, which slided by an impressive above 8, in between 8 and 9% last year, and coal by an estimated 5%, see that a 2.5% slide in gas is relative. And moreover, if you consider that liquefied natural gas is taken as a standalone commodity, it had actually grown by 2% last year. Of course, it's far from the 10, 11% that we were used to see in the previous year, but it's still positive. So gas has remained quite resilient against the backdrop of very exceptional circumstances that we've experienced last year. Now, on the next slide, we can see that, thank you. And the next one, please. Thanks a lot. We can see that part of this resilience can still be explained by some demand side adjustments in favor of gas and mostly at the expense of coal. The most visible one, as you can see on this chart, is the United States with a huge slide in coal consumption last year. This is mainly driven, of course, by price competitiveness. There's abundant production in the United States. It supported a 3% increase in gas-fired generation last year in the United States, in spite of negative electricity demand growth in the US. Total electricity consumption in the US was minus 2%. And in spite of that, natural gas increased 3% year on year and even reached its highest ever recorded share in the power mix in late July last year, about 45% of the US overall electricity production running on natural gas. At the same time, of course, coal slided about almost 20% decline year on year in coal consumption in the US. You can see also that in Europe, there's a similar phenomenon, but of course, gas also felt the negative impact, because of European development of renewables. But even though European gas consumption for power generation is less impacted, thanks again to the switching away from coal and lignite, also from support from some heavy nuclear maintenance throughout the summer in several European markets. Moving now to Asia, as you're well aware, see that for India, there's also an impact on coal consumption, with an increase in gas-fired generation. We see some similar impact in China. Of course, for both India and China, the role of gas in power generation remains a minority player to coal, but it's still an important factor to flag. But in spite of those favorable factors, power generation remained the most significantly affected sector in 2020. It accounted roughly for half of the impact on demand that we have estimated. It's almost 40 to 45 BCM out of 100 of global demand lost comes from the power generation system. So this is part of the story on how markets reacted on the demand side last year. So I will leave the floor to Gergely to explain what happened on the supply side.
Good afternoon, everyone. My name is Gergely Molnár. I'm a gas analyst within the Gas, Coal and Power Division of the International Energy Agency. And please allow me to join Jean-Baptiste in thanking our friends and colleagues at IGX for organizing and hosting this webinar. It is a real pleasure to be here today. India is one of the most fascinating energy and gas markets with an immense potential. And we are very proud at the agency of our work and cooperation with India. Just 2 days ago, on the 27th of January, the agency and the government of India has signed a strategic partnership framework to strengthen further our collaboration across a range of vital areas, including energy security and clean energy transitions. And now let's come back to our presentations. This graph shows how global gas trade evolved in 2020 along its main axis. In light blue, we can see global LNG trade. In dark blue, European pipeline imports, and in purple color, China's pipeline imports. Of course, the unprecedented 4% year-on-year drop in gas demand in the first half of the year was a real stress test for gas markets, unveiling the multitude of flexibility mechanisms along the gas value chain, including production shut-ins, pipeline supply reductions, LNG production curtailments, as well as optimizing storage utilization both onshore and on the sea. And as we can see on the chart, pipeline supplies reacted first and bore the brunt of the supply side adjustment, facilitated by the short-term flexibility mechanisms embedded in pipeline contracts. We do estimate that long-distance pipeline trade contracted by approximately 15% or 40 BCM in the first 3 quarters of the year. And when it comes to LNG, despite shrinking gas demand, global LNG exports grew strongly, up by over 10% in the first quarter of the year. In this context, Europe has been playing a crucial balancing role. In the first months of 2020, Europe alone absorbed about 2/3 of incremental LNG supply, despite its plummeting gas demand. Higher LNG influx has been accommodated at the expense of lower domestic production and nominating down pipeline imports. The majority of LNG exporting countries also experienced varying degrees of supply curtailment through the summer of 2020. As we can see on the chart in the third quarter, LNG exports decreased by approximately 7% due to a combination of shut-ins induced by historically low market prices, but also by planned and unplanned outages. And while the shut-ins in the US has been widely mediatized and widely discussed, it is important to note that almost 70% of the production decline occurred outside the United States. As a result of colder winter temperatures and the recovery in gas demand both in Europe and Asia, global gas trade returned to a positive growth through the last quarter, increasing by a mere 2%. This has been largely driven by higher pipeline imports into Europe and additional volumes of LNG flowing to Northeast Asia. Lower pipeline flows from Central Asia to China have been compensated by the ramp-up of power of Siberia. And if we move to the next slide, we will see how closely prices reflected those changing market dynamics. The sharp drop in natural gas demand in the first half of the year led to a collapse in prices, which plummeted to decade lows across all major gas-consuming regions. As we can see on the left-hand chart, by late May, TTF in Europe, which is presented here as the dark blue line, plummeted below $1 per MMBTU, and Asian spot prices, the purple line, fell below $2 per MMBTU through the summer of 2020, historical lows in both cases. And Henry Hub, the light blue line, was averaging below $2 per MMBTU through the first half of the year, its lowest level since 1995. And when looking at the second half of the year, the story is, of course, quite different, with all gas benchmarks recording strong gains, supported by demand recovery, supply adjustments, and unplanned outages. In the fourth quarter, all benchmarks were trading above last year's price levels, and as we will discuss in a couple of minutes, Asian energy spot prices ended the year with an unprecedented price rally. These strong price swings translated also into a high volatility, reflecting the unprecedented market uncertainty that prevailed through the year. Months ahead volatility on both Henry Hub and TTF averaged at 65%, the second highest level for both since 2008. And when we are looking sort of behind the lines, we can also see that the inter-influence between regional hubs and markers continued to grow in 2020. What do we mean by inter-influence? It means that gas prices in a given market are becoming increasingly sensitive and responsive to the supply-demand fundamentals prevailing in regions beyond their immediate geographical reach. One way to measure it is correlation. And what we can see on the right-hand chart is that the correlation between those benchmarks have been increasing in 2020, especially the correlation between TTF and Asian energy spot prices reached 0.95 this year, its highest annual level on record. And very importantly, the correlation between Henry Hub and TTF and the Asian energy spot prices have been also increasing significantly and reached 0.8 and 0.75 respectively. And we also see that this has been partly linked to the strong growth in US energy export, rising by more than threefold in the last 3 years, which sort of explains the growing influence between Henry Hub and other regional indices. In contrast, the correlation between oil and gas prices stayed relatively low, well below the 0.7 annual averages experienced between 2012 and 2016, when oil prices had a greater influence on Asian and European spot prices. And now, if we move to the next slide, we will see that the practical implications of this low price environment on the largest Asian LNG buyers who benefited from the record low spot prices in the first half of the year and from lower oil index prices through the third quarter. Depending on the market, energy import prices have fallen in a range between 20 and 30% year on year in 2020. And worth to note that buyers with a higher exposure to spot LNG, such as India and China, have benefited the most from declining prices. Having said that, the impact of the higher spot prices in December has been also more pronounced on those buyers. And we can also see that the import price profile displays in general a greater volatility. Altogether, the LNG bill of the 4 largest Asian LNG buyers fell by over 20% year-on-year in 2020, benefiting their economies and improving the cost competitiveness of natural gas, especially in the power sector, as presented by Jean-Baptiste. If we move to the next slide, we will discuss now the more short-term market dynamics and, of course, the infamous Northeast Asian price rally we witnessed through December and the first half of January. Due to a combination of demand factors, Northeast Asian LNG imports increased by over 10% between mid-December and early January. This has been driven by colder than average temperatures across the region, nuclear availability in Japan falling by close to 60%, and lower coal-fired power generation in Korea due to environmental limitation on coal-fired power plants. And in China, gas demand was up by over 10 to 15% through the second half of December as a result of a cold spell, while pipeline imports from Central Asia have fallen below last year levels. Consequently, Chinese buyers had increased purchases on LNG on the spot market. So how did this additional LNG demand has been met? If we can move to the next, we will see how the structure of LNG supply changed over that period. The increase in Asian LNG demand coincided with outages at regional liquefaction plants, including in Australia and Indonesia, leading buyers to call on more distant suppliers, and in particular the United States. And here I just would like to highlight that after we have seen the sort of downward flexibility displayed by the United States through the summer, we have seen this winter upward flexibility, which has been provided by the United States and which had been, of course, crucial to meet this additional demand. Having said that, of course, the shipping distances from the United States to Northeast Asia are longer, which also coincided with the congestion of the Panama Canal. And if we move to the next slide, please, we will see that as a consequence of this longer shipping routes, the mile tonnage went up by over 25% compared to September, and the availability of prompt vessels dried up. And charter rates, which are indicated here in the red line, have been, of course, reflecting this tightness and climbed to historic highs of more than $200,000 per day from less than $30,000 6 months earlier. This in turn provided further upward pressure to Asian LNG spot prices, which climbed to historical highs to above $30 per MMBTU by early January, and certain cargoes have been reported trading at close to $40 per MMBTU. And as we can see on the chart, this price rally has been rather short-lived, but it reminds us that the growing flexibility of the global LNG market, which of course helped relevant industries to find solutions in this very tight market situation. These price fluctuations also shows that the market short-term liquidity remains limited and timeliness is an issue. And now I would like to give back the floor to Jean-Baptiste.
Thank you, Gergely. So I'd like to take you now to the outlook part of our analysis, looking a bit further out to 2021 and what we do think may come into play in 2021. So our latest forecast does expect global natural gas demand to grow by 2.8% for this year, so which will enable to recover from the 2.5 decline that we have seen in the previous year, but it's far from being a jump into additional consumption. So we're not seeing what we had experienced 10 years ago, just after the great financial crisis in 2010, when global gas consumption was increasing 7.5%. This is just a rebalancing to where we were before the crisis struck. Anyhow, it is a rather uncertain outlook, and this projection that we're making comes with two main caveats. The first one, if you look at the left-hand side, shows the split of demand growth per region. You can see that last year it was mainly the mature markets in North America, Europe, and Eurasia that took the brunt of the impact. But for this year, we do assume that it will be Asia, fast-growing markets, especially in Asia, to a lesser extent in the Middle East and Latin America and Africa, that will be at the forefront of the recovery. So if you look the balance in between 2019, 2021, just at the left of the chart, you see that the overall balance for the crisis and recovery is overly positive for fast-growing markets, mainly in Asia and to a lesser extent in the Middle East, but overly negative for mature markets, and particularly for North America, where the slide will not be recovered. So we do expect that while Asian markets, to a wider extent, and other fast-growing markets will see some growth this year and keep growing in the future, more mature markets in Europe, North America, Russia, and other areas in the Northern Hemisphere may not be able to return to their pre-crisis level by the end of this year. The second caveat that applies to our forecast is a sector-wise approach. You can see on the right and the chart, we've splitted our forecast by sectoral contributions. So if we look at what we do see for this year, 2021, we do expect that power generation will be in a difficult situation globally. Power generation used to be the main driver of gas demand growth, especially owing to fuel switching away from oil and away from coal. This year, the contribution of power generation will be limited. First, because we do anticipate a modest growth in total electricity demand, and second, because gas will be struggling and squeezed in between renewables expanding and a potential comeback of coal on lower coal prices and increasing gas prices compared to their very low levels that they have experienced last year, as Gergely has shown you. So we do expect that power generation losses from last year will not be fully recovered this year. The main driver of growth in terms of sectors is and will remain, in our view, industry, especially in Asia, thinking about heavy industry and also petrochemicals and the use of natural gas as a feedstock for non-energy purposes, for fertilizers and petrochemicals. Most of the growth for industry comes from Asia, from China, India, Southeast Asia. But of course, it comes at the risk of a delayed economic recovery, because in those major and fast-growing markets, there's a high share of industry production, which is export-driven. So if the economy doesn't restart as smoothly as anticipated by the IMF projection that we use as the backbone for our macroeconomic assumptions, then of course the prospect of industry activity and therefore energy consumption for industry activity will be hampered. Last point, residential and commercial. Last year was heavily impacted in the Northern Hemisphere because we have seen a very, very mild winter and first quarter in Europe and North America. We do expect some rebound this year, but it's only a one-off because it's only the contribution of returning to a normal winter, which can also always be challenged. We've seen some cold temperatures so far, but you never know what can happen later in the heating season. And beyond this year, we do not see that much growth potential for residential and commercial demand, especially for heating purposes outside of China. Of course, there are some very ambitious city gas rollout programs in India, in Indonesia, and other Asian markets, but those markets are not temperature sensitive. So we do expect to see a gradual growth, but which will not be as seasonal as for more temperature sensitive markets. So to to sum that up, global gas demand recovery in 2021 is highly uncertain and subject, of course, to a variety of risk factors, including fuel switching capability, slow industrial rebound, and the risk of milder weather, which can moderate consumption. So if we're moving to the next one, please. Excuse me, can we move to the next slide? Thank you very much. So, ladies and gentlemen, to wrap on this analysis, I would like to stress some key findings from our analysis. The first one is, as Gergely mentioned, we have seen a huge supply shock, which was needed to mitigate the impact of the demand shock, and LNG took its share in this supply adjustment required to balance falling gas demand in the first half of last year, and therefore proved, if needed to be proved, confirm its flexible contribution in case of sudden and unexpected demand drop, as it also confirms and still confirms today in the tight market situation, its ability to ramp up in case of sudden and unexpected increases in demand. We have seen some huge price movements and volatility throughout the year, from historical lows in May and June up to record-breaking highs in this month of January. But the current supply rush is a short-run phenomenon. We already see prices coming down from their high levels, and doesn't herald a major demand rebound for 2021, both in terms of global gas and global LNG consumption. The driver of growth for this year remain fragile, and of course, any prospect of a prolonged health crisis and delayed recovery will negatively impact those rebound prospects for back to 2019 gas demand levels. Another thing worth mentioning, which is going a bit beyond the view that we have been presenting today, is that when it comes to LNG, the picture is particularly challenging, but also offering opportunities in the medium term. Because on the one hand, I won't go back to the uncertainty and the demand side, there's also a lot of opportunities to be caught on the supply side. In the next 5 years, there's about 1/3 of total contracted volumes in the LNG market due to expire. About 200 BCM of gas contracts expiring. At the same time, LNG supply capacity, the liquefaction capacity is due to expand by 20%. So there's a huge room for opportunity for LNG buyers to strike new deals, and also a commensurate challenge for LNG sellers to market volumes to buyers in such an uncertain demand situation. Of course, the IEA is closely monitoring the situation, has been siding with all its member states and association states and beyond them ever since the beginning of the crisis, and part of those efforts to increase the outreach visibility on gas markets. It's our pleasure now to have this report being published on a quarterly basis rather than an annual basis as we used to. And this first issue being issued this week. And again, a great pleasure for us to have this opportunity to share our results from this very first quarterly report with you today.
And now we are moving sort of to the second half of the presentation. Thank you. In India, the government's vision for a gas-based economy is closely interlinked with the liberalization agenda for the gas market. And it is really great to see all the good progress which is happening on that front. The launch of India's gas exchange in June 2020 and the announced unified tariff structure for gas pipeline transportation in December are important steps towards the establishment of a liquid wholesale market and are clear signs that the timeline of gas market reforms in India is speeding up. Gas market reforms are, of course, a complex and a lengthy process. And as we can see on that timeline, both the European and the North American experience shows that it takes at least 10 years to establish a well-functioning, competitive wholesale gas market. Having said that, we believe that strong political commitment, stringent regulation, and international experience sharing can help to fast-track gas market reforms, which in turn can hugely benefit economies recovering from the current global crisis. So, what insights can be taken from the European experience in terms of gas market opening? But before trying to answer this question, I just really would like to highlight that each energy and each gas system is unique by nature, and hence there is no single path to the establishment of a more competitive gas market. However, there is a number of factors that should be considered by policymakers and other relevant stakeholders, which can foster competition and support the development of trading. So what are the building bricks of a competitive gas market? And if we move to the next slide, would it be possible to move to the next slide, please?
Yeah.
Thank you. Thank you very much.
Just give me 1 second, I think.
So maybe I will just start to explain the slide, and we will have it soon on our screen. So I think that this slide will give us just a bird's-eye view on the key success factors behind the establishment of a competitive wholesale market. First, a gas supply and system and infrastructure able to meet the average seasonal and peak demand requirements of consumers is considered as an essential element for the creation of a liquid wholesale market. A diversity of supply sources, and most importantly, a diversity of upstream suppliers, can be beneficial for the development of competition and usually improves the liquidity on the hub. The availability of midstream flexibility, including pipeline flex, storage, LNG, allows not only for a greater degree of supply security, but also provides the physical space necessary for short-term trading and balancing actions. Second, the regulatory framework should enable market participants to access the, so the second layer of that graph shows us that the regulatory framework should enable market participants to access the gas infrastructure and the midstream flexibility products, such as entry-exit capacity at pipeline interconnection, working storage, LNG regasification capacity, on a non-discriminatory, objective, and transparent basis. Tariffs and the methodologies used to calculate them have to be approved, of course, by the regulatory authorities, have to be transparent, should reflect actual costs incurred while including an appropriate rate of return on investments, and should be applied on a non-discriminatory manner to all market players. The balancing regime shall be market-based and include cost-reflective imbalance charges to the extent possible, set on the basis of the marginal price. And very importantly, the TSO shall provide market participants with operational transparency in terms of firm and interactive capacity available, tariffs, nominations, renominations, and physical flows at least on a daily basis through an open and transparent information platform. This is crucial to reduce information asymmetries among market participants. The third layer shows us that a key cornerstone of a competitive gas market is the establishment of a liquid hub. Hub design should facilitate the development of trading, and we will discuss this in more detail in a couple of minutes. It is very important that market participants need to embrace the challenges and opportunities offered by competitive open gas market. And of course, this is a learning process involving a changing vision of the market, investment into the development of trading capabilities, acquisition of trading tools, training the personnel, and so on. One important point here is the reform of sales contracts. In fact, any clauses hindering the resale of gas or prohibiting consumers to switch suppliers should be gradually eliminated to further enhance competition. And fifth, the trading activity in the wholesale energy products has to be monitored, either by a national regulatory authority or by a designated institution to detect and prevent any form of market manipulation. This is of particular importance in the early phases of hub development, when liquidity is still relatively low and the risk of market manipulation by a dominant player remains rather high. And if we can move to the next slide, please. We mentioned earlier that a key cornerstone of competitive gas market is the establishment of a liquid hub, which guarantees that gas is exchanged among market participants in a time and cost-efficient manner. Hubs can be either physical, when referring to well-designed geographical point, or virtual, within a well-defined entry-exit market zone, which allows market participants to bilaterally transfer title of gas, disregard where the actual physical volumes are located within the gas system. In all cases, hub design should facilitate the development of trading. Access to the hub should be provided on a non-discriminatory basis. The licensing procedure should be transparent, and participation fees, if any, should not severely increase entry barriers. Beside title transfer, a hub operator may provide additional commercial services such as wheeling, parking, peaking, and so on to enhance the short-term flexibility and the firmness of the hub. The offered product range should be diversified, both in terms of time horizon, day ahead through months ahead, spot trades, as well as forwards and futures, and in terms of trading instruments, including swaps and options, to allow market participants not only to balance their short-term positions on the physical market, but also to manage price risks over different time horizons. On a well-functioning hub, there is a constant high degree competition between market players. And if we move to the next slide, please, we will see that thanks to this constant competition, a well-developed liquid hub guarantees not only a marketplace where demand is matched with offers in a time and cost-efficient manner, but also provides market participants with price discovery, the actual and expected market value of natural gas. On this graph, we can see the spot price of TTF, Northwest Europe's largest gas hub. Consequently, oil index price formulae in gas sale contracts can be replaced with indices linked to gas products traded on the hub. And in order to reduce the rather high volatility that prevails on the traded market, hub-based pricing formulae in gas sales contracts to end consumers are usually based on an average of several months, the so-called reference period, of multiple gas products traded on the hub. And as we can see, the light blue line, which is sort of the hub index proxy, displays a much smaller volatility than, for instance, the spot prices on TTF. So with that, I would like to end our presentation, and we are looking to the next presentation. Thank you.
Thanks a lot, Greg. Now I would like to call on.
Yes, you can. One second. Rajesh sir wants to speak.
Thanks a lot, Mr. Baptiste and Molnar. It was really wonderful. Maybe Chandrakanta, should we take questions now or a bit later? Because if you can give the opportunity for two people to ask questions, maybe for the next 15 minutes, and then we can take up the next session, Deepak.
Yeah, fine, sir.
Yeah. Just one question from my side, Mr. Baptiste, that always people are interested to know what is the projection in terms of prices. So do you have anything, or can you make something for next 3 months, like March to maybe June or July? What is the likely price for ASEANs?
Well, unfortunately, we can't make any price forecasts. We're just analyzing the markets, and we're basing our analysis on the market prices and future curves, which has their own limits, as you know. But if we look at the fundamentals, first, what we can say is that oil prices are firming up. So we see that they're recovering from their very low 30 around dollars per barrel, almost double then. And of course, there's a time lag in the construction of the oil index formulas, but we do expect oil pricing indexation to slightly increase in the coming months as a result of Brent taking up. Second, on the spot and gas-to-gas competitive markets, well, we have seen very high prices there in Europe and particularly in Asia, and as we're slowly getting out of the heating season in the Northern Hemisphere, we do expect those prices to cool down. It is already taking place, but the JKM is still with close to $10 per MMBTU for next month delivery. So it's still above what we've seen last year. Beyond the heat season is normally the shoulder month, where we will probably see a calming down of prices. Of course, it all depends also on the availability of supply. We've had up to 15% of total liquefaction production down last year due to planned and unplanned maintenance. There's still some facilities in Australia and Indonesia under maintenance. It all depends which extent they'll be able to come back to the market sooner or later. So sorry for not being able to give you an exact figure, but we do expect, of course, that we will come out of the seasonal cycle, and the big expectation is what's going to happen this winter. Of course, in terms of demand, is if it's going to be a hot summer, and therefore putting electricity prices up, and therefore seasonal demand for cooling, and also what could be happening on the supply side. Do we foresee extended maintenance, or will this additional liquefaction come back to the market?
Thank you, and we will look forward to your quarterly analysis. So when the next report is expected?
So we don't have an exact date yet, but it should take in the second half of April.
Okay. Thank you. Mr. Molnar, from your side, you said these enabling framework you very well explained for a good competitive market. And of course, we don't have everything in India. We have some, not everything. And largely, we are missing on many of these enabling provisions. So what do you think that what is the key two or three most important enabling things which we should have so that our markets are really competitive?
So I think that, and please let me also just congratulate India on the commissioning of the Kochi-Mangalore pipeline, which you know is really, I think that where things should going is, I think that the build up of the physical midstream assets. I think that this is a very, very important point. But here I just would like to highlight that it is, of course, very important in terms of pipeline interconnectivity, but it is also, I think, an interesting point to consider the short-term storage space, which is not only for seasonal purposes, but it can be also very, an interesting component in enhancing the short-term deliverability and reactivity of natural gas, also vis-a-vis of variable renewables. Also, I think that we can say that having short-term storage in place enhances usually trading activity because it is just the physical basis, one of the physical bases you trade on. Having said that, I'm, for instance, from a country which has a very, very good gas infrastructure, and it does not have a competitive wholesale market. So it is, but it is a very essential element, and I think that India is doing a fantastic job on that, and this needs to continue. The second component, I think, is the regulatory framework, and really to, the legislative framework, but also the different network codes. I think it is very important that all market players who want to play in the market have, needs to be on the same level playing field, needs to be equal, because this is what, puts competition at best. And I think that one element, and which is sometimes overlooked, but I think it is very important, is the role of the hub operator. The hub operator, there are different ways to. Sometimes it is the TSO who is the hub operator. Sometimes it is an independent entity. Sometimes it is the mixture of the two. But it is very important to have it and to give it a prominent role in the beginning of the hub development, because this is what is going to enable sort of the physical firmness of the hub. And when you have the physical firmness of the hub, then it is easier to develop also, the derivatives and the more forward products. So this would be my view.
Thank you. Just another question linked to it. Like we don't have a TSO today. We are having pipeline operators. And as you said, we should also have a TSO, we should have a hub operator, and we should have a market operator. So we operate the markets. Now, given that situation that we may not have a separate hub operator, so in your view, can exchange also operate the hub? Because the exchange as such is also one of the neutral agency in the whole ecosystem. So do you think it's possible?
So I would not be in a position to give you a response now. I'm not aware of such an example in Europe. But as I said, there are sometimes a hub operator, which is an independent entity from the TSO or from the pipeline operator. And for that, there is in that hub operator, there is an owner share, which is partly owned by the TSO, partly owned by other market players. So I think that it might be that in sort of this hybrid regime, there could be a role for an exchange. But again, I'm not in the position to give you a prompt response on that.
Yeah, maybe think over, and then you can give your views later.
Certainly. Thank you.
CK, are you getting any questions?
Yes, sir. We do have a few questions. So there is a question on what is the correlation between crude oil prices and spot LNG in last few like what has been the what sort of correlation has been seen in last few years, and how many long-term LNG contracts are being linked to crude prices as of now?
So just maybe to highlight that in the past there have been a rather strong correlation, statistically significant correlation between oil prices and Asian LNG spot prices, which was around 0.7 in the period between 2016 and 2012. Now, if you look now, it has been rather low, so it is not statistically significant anymore. It is, it can be even negative. And Having said that, when we look at the share of oil indexed volumes in the long-term contracts, it is still largely the predominant pricing mechanism, and it would account for over 70% of the LNG traded under long-term contracts. But Jean-Baptiste, you wish to add to that something, right?
Yes, thank you. Well, just to repeat what you just said, in terms of volumes, oil indexation remains the main contribution. It's, if I'm not mistaken, it's about 60% of export volumes and 80% of import volumes. So how come there's a difference in between the export volumes and the import volumes? Simply because now that LNG markets are becoming more complex, it's not only back-to-back transaction in between a producer and a utility or a or an end user. You have resellers, midstream players, big oil and gas companies, most of them who are in between the producer and the consumer. Those companies, which are usually referred to as portfolio players, they buy LNG from the liquefaction companies and resell it to end users. And they tend to buy hub indexed, mainly from the US, and resell oil index, mainly to Asian buyers. So the trend, if you look at Asia, the rate of oil indexation is above 90%. So it remains a strong trend. It's moving slowly but surely towards more hub indexation, but oil indexation is there to stay as long as those legacy contracts are there to stay.
Right. Thank you. The next question is, how can you see the correlation between Henry Hub, TTF, and JKM going forward with supply issues at Panama Canal to continue?
So if you don't mind, Gege, I'll take the first bit on Henry Hub and the connection with the rest of the world. So far, Henry Hub has been isolated and insulated from the price moves on markets, simply because the US hardly imports any LNG apart from 1 or 2 cargoes per year for the Northeast, and exports truly, but those exports do not come in competition with domestic markets. What we are seeing, though, is that the cushion of US supply is getting thinner and thinner because domestic production is declining. It's been declining about 2% last year, and it's expected to decline another 2% this year, mainly because US oil production is going down, and therefore associated gas production is also going down. So we may see a bit more of correlation in between the Henry Hub and other prices, as they could eventually be a bit more arbitrage in between the domestic market and export market, but it still remains very, very limited. And so for the European and Asian arbitrage, I'll leave it to you, if you don't mind.
Yes, so as mentioned, thank you, Jean-Baptiste, and as we mentioned in the presentation, the correlation between Henry Hub and other regional price indices have been growing strongly in the last 3 years, sort of in line with the growing exports of the US. I think that first of all, correlation is a way to measure the inter-influence, but I mean, it is not an ideal way of measurement, so it has its own methodological limitations. And I think that this is a very interesting question: is the high level of correlation between the regional prices we have seen in 2020, is it going to stay? What we think is that the enabling factors behind it, namely flexible volumes of LNG, which is spot, but also the LNG which has destination flexible contracts, and the marketing strategies of market players evolving towards greater optionality are going to stay here, and they are sort of going to maintain a certain level of of correlation between regional price indices. Then what we have seen on the Panama Canal congestion, I think that two issues to consider. One is that there is a certain seasonality involved in that, because there is a certain seasonality in the flows from North America to Northeast Asia. So this is a seasonal factor. The second consideration is more long-term. What are going to be the impact of that? Could we see, a higher build-up of LNG charters, and most importantly, those which are available for short-term transactions? Maybe there could be a move in the market towards that. And the third question is how will the capacity of the Panama Canal evolve? Could be that the throughput of it will be increased because there might be a growing demand for that.
Thank you. Our next question is, as we see, Japan is one of the most mature import market in the world. How do we see India compared to Japan on all the parameters like hubs, physical supply, and what can be done? What can be the most challenging for the Indian traders?
Well, this is a very interesting one, because although Japan is one of the most mature LNG markets and the biggest LNG importer in the world, the transition to a fully competitive market, domestic market, is fairly recent in Japan, and the process of downstream opening has only been completed in 2017. So it is now fully open, but in terms of third-party access to infrastructure, it is still under development, and the access to main infrastructure will be only granted by 2022 in order to give time to the incumbent utilities to manage the use of the infrastructure appropriately. Because the situation in Japan, if you compare it to India, is that the network is, due to the geographical situation of Japan, is a patchwork of networks which have limited interconnections. So each region in Japan acts as an independent region with its own supplier, and the interconnection capacity, whether it is pipeline or reloading facility from one sub-region to another, is very limited. So it of course raises a lot of questions in terms of regulation in order to smooth the third-party access system, and also prompted this lack of interconnection plus the 100% reliance on LNG. There's no domestic production and no pipeline in Japan, has prompted to overdevelop tank storage capacity if you compare it to the average needs of the Japanese market, because of this lack of interconnection. So I think the situation in India is a bit different, because the demand is growing and is supported by very ambitious policy targets to increase the share of gas in the domestic mix, to roll out city gas systems, to develop the role of gas in transportation, but also, of course, to ensure the backbone of fertilizers production for the agriculture industry sector. So I guess that the situation of an expanding market with expanding infrastructure is fairly different. And as Gerge mentioned, India is already on the forefront in terms of development of its regulation to enable that the development of both the physical infrastructure and also the software of regulation go hand in hand to further develop the role of gas for the Indian market. Gerge, I don't know if you have you have additional comments on this one.
Thank you. I don't have any additional comments on this question.
All right, we'll move to the next question. In one of your slides, you have mentioned historical lows, recovery, and volatility. On the face of it, I get the low and the recovery, but what is driving the volatility?
So, as we mentioned, indeed, the volatility has been rather high in Europe when TTF Mansa had the Mansa had contract had a volatility of 65%. Henry Hub had a similar level of volatility, and Asian energy spot prices have been also very volatile and have been extremely volatile. Of course, by the end of the year and by the beginning of January. I think that volatility is mainly can be driven by two things. When we look at the short-term product volatility, so for instance, intraday volatility or day-ahead volatility, it is mainly driven by the physical movements. It might be a congestion, it might be some imbalances in the gas system. But when we see a higher volatility on the products which are in the near curve, and we took the months ahead contract because this is the one which is the most traded on TTF and on Henry Hub, I think it is much more related to the certain sense of uncertainty with which market players have been faced through 2020. And I think that this is just related to the overall economic uncertainty many of us have been facing in the face of the lockdowns, of the uncertainties, how will the economy recover, what will be the shape of that recovery, what will be the geography of that recovery. So I think that this is very much linked to the general market uncertainty in all these markets.
Next question is, according to you, what is the wiser choice for Indian buyers for FY21? Oil parity or JKM linked prices?
Yeah, leaving this question.
I would certainly not be in a position to give an advice, but rather answer the question by another question. I think it really depends on what you are expecting as a buyer. If you're looking for a certain visibility on the prices at the expense of taking the risk of buying higher, I guess that as most risk-adverse buyers, the easiest option is to take the oil indexation, whereas JKM is increasing its liquidity, but remains, as we have seen in the past weeks, more prone to volatility. So I guess it's more of a bet in the current market situation.
Thank you. Yeah. So Chandrakanta, now very limited time. Deepak, what do you think? We should complete this Q&A, or we'll have maybe a bit of extension, but 10 minutes. Can you do that?
Yeah, I'll try to cover in 10 minutes, sir. Before that, I have a question for JB.
Okay.
So, JB, what we have seen in crude oil prices in last, say, 1 year, I mean, crude falling in negative territory, how right it is to correlate natural gas with crude oil prices? Even though I am a consumer of natural gas, but still for my long duration contracts, I want to have a linkage with crude. And we know that there is actually no correlation between both the commodities. So is it the right approach for, as you mentioned that in European market, still the practice exists that for long duration contracts, the buyers prefer crude link contracts?
I guess that the situation I'm talking under Gerge's control. The situation for Europe is a bit different in the sense that the more competition you have in terms of different sources and different sellers, the more incentive you will have to go for a hub-based price. So if we're looking at European markets, which are well interconnected, have access to LNG, eventually have access to domestic production and pipelines, the added value of taking an oil indexation is very limited, because you know that the liquidity, the physical liquidity and the adequacy of the price index of the hub will be good. If we're looking at European landlocked markets where there is only one dominant supplier, the quality of the hub signal is not as good. So it's difficult to translate that in the context of LNG markets, but I guess that what we're seeing in terms of LNG contracts is a great creativity in terms of new contracts being signed, some of them using hybrid pricing with a more or less important share of Brent, some of them fully indexed on either TTF or Henry Hub or a blend of the two. But there you're switching your commodity risk from oil to gas to American gas to Asian gas fundamentals, for instance, because I don't know, assume that there's a price spike in the US, but nothing changed in Indian or Chinese market or wherever it is where you're buying. Then you take the risk from the American market without having the impact on your market in terms of fundamentals. What we really are looking forward to is the emergence of hub references such as the and price references such as the IGX, which really take on board the fundamentals of supply and demand of the domestic market rather than taking the risk of importing the fundamental of another market to Asia.
Yeah, thank you. Yeah, CK, maybe we can cover IGX presentation in 10 minutes. Maybe we can then continue the Q&A.
Sure, sir. I'll just share the presentation.
Yeah.
Deepak, the budgeted time is going to be over, so maybe we won't be able to take. If I don't know, Gregory and
what we can do, sir. What we can do, we have all the email IDs. We'll email the IGX presentation. Maybe we can continue with the question and answer, sir, if you feel that's the right approach. Because we have covered this presentation earlier also.
So do you want that we should continue with question and answer for? There's only 2 minutes left for the budgeted time period.
2 minutes में तो नहीं होगा sir. Then it's better we take Q&A only, sir.
Okay.
Yeah, CK, maybe you can continue with the Q&A. Even if there are questions related to IGX, you can take those questions also.
Yeah.
Sure, sir. Given the current uncertainties in the global market, keeping in mind a country like India, where a number of individual gas operators are operating in a designed geographical areas, what can be a good strategy for a bigger foreign player to have a market entry strategy in Indian gas market? Like we have seen that Total has entered the Indian gas market and renewable market in partnership with Adani, which has a considerable market cap in both CGD as well as the renewable energy market.
Well, I am not an expert of the Indian domestic market, so I don't want to say any nonsense. But my understanding is that differently from a lot of other fast growing markets, the entry barriers are very limited for a foreign player to enter the Indian markets. It's an open market. It's not like there are some either regulatory limitation or there is a state-owned monopoly that holds the market together. But at the same time, as I'm not an expert of the market to talk about the regulatory framework. I guess that if you're a foreign investor, you're not an expert of the ins and outs of the Indian market to try to get some market share. So I think that the example that you have provided of Adani partnership with Total is an interesting example of trying to get together and take the best of competences and knowledges to help contributing in the development of renewables and natural gas in India.
All right. What are the impediments in India, according to you, for a well-functioning competitive?
I can just add what JB said. Maybe for international sellers, they can follow the model of fixed plus variable. Maybe they can have tie-up with the few of the consumers and balance quantity. They can look for IGX. They can sell that quantity on the IGX platform. Since we have plans to launch long duration contracts also, so even an international seller bringing his cargoes, they want to sell on fixed plus variable, they can use both the platforms.
Yeah, but only thing on the strategy side, this is a business strategy of each individual player.
Right.
That if they want to come and join with hands with one of the existing Indian player, that definitely is better. But there is no entry barrier to people, or there is no other requirement for them to enter into this gas market. So others can anyway enter the gas markets. Of course, exchange provides aggregated buyers, so that part is taken care through exchange. But if there is international seller coming into India, I think that's possible.
Yes, sir.
No barrier.
Going to the next question, what are the impediments in India, according to you, for a well-functioning competitive gas market? So we have already, Greg has already taken us through the competitive hub, I would say, but here the question is for a competitive.
Yeah, Gregory has covered this in his slides. But any more comments from Gregory?
I think that now the next steps will be really to first of all, again, the infrastructure is a key element is a key component, and the second is really to move ahead with the development of the network codes or whatever you want to call them, but the rules which apply to all the market players on the same way. I think that those are really the crucial points.
Yeah, I can add from Indian side, like we have also tried to find out which are more important ones. So Gregory already covered this very well. One is on the supply side. You should have a diversity of supply, and on that we are working on how the domestic gas can also be sold in the market. And India, the bigger advantage is that we not only have LNG, but also domestic gas, which is not there in Japan or in other countries, or maybe China they have, but we are different from Japan in that sense that we have a very good mix. 50% market is LNG, but 50% is domestic. So today the domestic is cost regulated. We would like that should be some gas free from that regulation, and that should come to the market, so that can provide a bit of supply diversity. On the buyer side also, we feel that there is some diversity should be allowed. Currently, what happened that so far, because there was no exchange platform with the flexibility of buying for 15 days or 1 week or a day. So most of the contracts required that it should have a contract for say 3 months. So fertilizer particularly is buying a lot of gas, LNG, but they are buying for 3 months through a pooling arrangement. That part can come to the market so that there is more diversity on the buy side. And of course, on the regulatory framework, we feel that there is some important change which we need to do on taxation, because in India we have actually moved to a regime where there's a common tax across the country for all commodities, but except for gas and petroleum and alcohol. So gas is something which is a B2B commodity, and we feel that that can come to under GST. So that can actually make uniform taxation for this commodity. So if someone comes to the market, it doesn't make difference whether he buys from south of India or other parts of the country. And on transportation tariff, we have seen that a few things have happened. We have done one set of we have moved ahead with the tariff, with the two-zone tariff. But of course, we would like to go to entry-exit, what Greg also said. And that's there. We hope that in the next round of reforms, probably we should be able to move there. And then transparency in capacity access. That's something more is desirable. Though we have a bit of transparency, but not a complete transparency. And there is some changes we have. We think that should be there, so that somebody should be able to buy for 1 day, even for tomorrow, or for same day, or for a week, or so. All those possibilities will come when we will make some few reforms in our capacity access regulations. So of course we will be talking about more on hub side, whether we should have a hub operator. But before that, we are now currently looking for having a TSO in place, and for that also already there is a plan, and we hope that in 6 months' time, if TSO is in place, probably that will be helpful for competitive market. CK, I think we can close now. Already we are over time, and probably everybody will be. So maybe next round we can do it. Given that our experts will be able to spare some time. So depending on in a quarter, suppose we do it once, that would be wonderful. We won't like to disturb you every month, but quarter can be a good frequency for such interactions. And you will also know more of Indian markets. And of course, you have good understanding, but still there will be a direct connection with our stakeholders in India. So I think we can close, CK.
Sure.
So thanks a lot, Mr. Baptiste, Mr. Greg, for wonderful talk today. And I hope that everybody would have got good insights. It was really very meaningful discussion today. So look forward to more such meetings. Thank you.
Thank you very much, sir. It
you very
was a
much.
pleasure.
Thank you very much for hosting us. Looking forward for the next time. Thank you.
Thank you. Thank you.
Thank you. Bye.
Thank
Bye.
you. Take care.